All right. It is 2:15 my time. No, I'm just kidding. Today we're looking at how the market reacted to the CPI report. Okay, so the CPI report came out this morning, and you got core, you have headline inflation. Those are the two gauges you want to look at: headline inflation, core inflation. We see the S&P 500 really starting to support that previous resistance level. We're still there, right? We've been at this level for a while. Nothing too drastic happened today. And as we called the other day in the newsletter, we said, hey, I think inflation, right? Where's the newsletter? We talked about this yesterday. This is our newsletter. And let me make sure that's zoomed in. Yeah, you can see it pretty clearly. Good. So in the newsletter, I said, hey, I anticipate headline to come between 3.3%, right? And we know this is all coming from oil prices surging, which are right exactly at the big resistance level at 83.50. Got rejected a little bit, but they still have a lot of momentum. There's a couple reasons why oil can roll over, but it might not happen for a while. So we might have this elevated oil price, but if it moves sideways from these levels, CPI will still come down. Anyways, we said core CPI would come in between 4.6 and 4.7. The market was expecting 4.8% core, but I thought it'd be lower than expected because there's usually we've seen more progress in core lately because it's obviously coming down in the shelter area, the area that is really has been very sticky. All right, so jumping over to the calendar, let's take a look a little deeper. Let's start with the month on month. So the market for core, okay, core is what the Fed is looking at. The market was expecting 0.2%. We got that. Now if you let me zoom in here, if you focus in June, July, you can obviously see that core inflation on a month over month basis, and this is important for core, for the last 12 months is consistently 50% lower, right? It's consistently dropping. And I think the core actually starts to make more progress than headline inflation. That is X food, X energy. So you take out oil prices. Oil is the big risk right now. Oil surging is a big risk. It'll increase input prices, input costs for energy, and hurt the consumer to some degree, right? With the slowing economy already at hand. But we do see cores coming down. We do see core inflations coming down on a month over month basis. And I expect that to continue to fall. So 2 months in a row at, way below where it was previously. Now, if we go to just the inflation rate, this one's a little more volatile, but the headline inflation rate, so adding energy, adding food, it's also at 0.2. But it is kind of, it's trending lower. It's had a bump, it had a bump, it had a bump, but those bumps are getting smaller. So the bumps, and this is the rate of change. This is not your price, right? This is not just the price of bananas or the price of whatever it is. This is the rate of change on a month over month basis. And that rate of change is coming down, meaning it's decelerating. It's not accelerating as fast as it was, but it still goes up. Prices go up no matter what. Now the year on year data is what I like to look at. We finally bumped higher. Okay. Now, I also want to mention this about inflation. This is very important when it comes to inflation. Where's that tweet at? Okay. So if we take a look here, Bespoke kind of wrote the CPI is expected to jump 3 to 3.3, right? And we came in at 3.2, which was better than expected. The market initially moved up, sold off, and I think it just needs to find support. We need to find where the buyers actually are. 444, I'm still looking at for S&P. We're at 445. So by the end of this week, because we get PPI on Friday. So by the end of this week, I think the market will find that bottom because the inflation numbers are actually not too bad. They're actually pretty good. They're actually not bad. So if you take a look here, this is the biggest streak ever for CPI to fall. Streak of monthly declines on a year over year. CPI is set to end at 12. So we basically had 12 months of declining CPI, and now we get one little bump. So don't freak out. We get one little bump higher on a month over month basis. Okay. This is year over year, but we get one bump higher. It's nothing to worry about. It's a small bump and we know exactly where it's coming from. This is the good thing. This is why the market won't get too spooked. We're not seeing volatility spike because we know the bump is coming from these oil prices that have been moving up significantly. So obviously the higher oil moves, the faster it moves, the more risk there is to the market. So it's pretty one for one. There's no surprises. If oil trades sideways, then that headline CPI number will, start to turn back down. So really, when you think about inflation, there's two parts to it that the market and that the Fed is looking at. Okay, headline inflation, and really our proxy for that is oil prices. You just literally look at oil prices. Where are they headed? Are they headed higher? They are above. They are trying to get above that big level, that 83.50 level. If they get ahead of it and they start moving higher, then we know headline is going to be stickier. We know headline is going to jump back maybe 3.5, or maybe it sticks at 3.3. But it's definitely not dropping into the twos until we get crude oil back down. Now, core is the sticky part, okay? Core is the sticky part. And this isn't core, though. This is just showing the headline CPI year over year. And if you see right here, this was the biggest decline on record, right? Going back to the 30s. Yes, going back to the 30s, this was the longest streak of declining CPI on record. So don't tell me there is no progress on inflation. We've seen inflation pretty much drop like a rock. This is the first bump in 12 months. Okay, first bump in 12 months. Now, back to the actual report when it comes to core. This is where I thought there'd be a surprise, right? The market was expecting, or the consensus was that core would come in at 4.8. Okay, 4.8, which was June's, and we came in at 4.7. So it is trickling lower slowly, but it is coming down. Okay, it is coming down. So you see the trajectory is still pointing lower. If we look at it on a line chart, which I think is a little easier to see or notice kind of what's going on, we go back 10 years, you see that core is dropping. Okay, core is coming down into that 4% zone. It is in restrictive territory. The Fed's at 5.5%. So basically, progress on inflation continues. There's still continued progress. Now, the issue comes, and the other part of that macro report was the continuing our jobless claims, the 4-week average of jobless claims may be bottoming here. Okay, maybe that's not a good chart to look at. It may be bottoming. So we did swing high, right, from into July, and then we kind of not sold off, we kind of came down. But those jobless claims may be turning back up. So, that kind of puts pressure on the Fed to pause if they do start to surge back up, right? So inflation's coming down. Jobless claims may be going back up. So unemployment may tick up going forward, even though it's still low. And I think that keeps the Fed on pause. We still have another month before the Fed makes a decision. We got another CPI report before the Fed actually makes a decision. All right. We did have some Fed speak, but I want to go to the technicals because really – all the macro, we got the headline CPI, it's lower, right? Gas 4%, $4, beef, $20, heating, oil 4, no inflation. I don't know if you're being sarcastic there, Dima Yush, but what I would say is that the rate of change of inflation is coming down. So this is all privy to not the consumer. We know the consumer is already going to be under heat for inflation, right? For prices up, but the rate of change of prices going down, right? Inflation falling for the last 12 months. That is in regards to the stock market, to asset prices. Okay, so not the economy. We know the economy is a little hotter. Obviously, we know consumers have to pay more than they did in the past, but that's always been the case, right? That's always been the case. Prices always go up. Prices don't come down over time. They always go up because we are in a system that literally fuels growth through inflation. So that's not a surprise there. It is more so that the inflation rate falling is going to give a bump to the markets, but the markets have been up pretty strong. So anyways, getting back to it, let's look at the actual technicals. Let's look at I see what you're saying. The Fed dovish on inflation to reaccelerate. Yeah, that's there's a scenario for that. Really quick on the technicals, and I'll get to that comment. You can see the S&P is really just pulling into the 4,400 level. All right. Qs have dropped, so technology has got hit significantly harder. Obviously, they did break that downtrend, so they broke the they broke the uptrend, and now so we're looking at the Qs coming into that next support. So it broke S1. I like to call S1 support run at 372. Now we're coming into S2 at 366. Okay, it could be, maybe it's a different support zone, but that's what I have, 366. That's the next zone. There's a lot of layers, though. There's a lot of support for the Qs because the Qs have been leading the market for a while. So they can, obviously come off or rotate into industrials, rotate into the equal weighted averages a little more. And this is just the Qs market weight average, right? Look at the Dow. Well, the Dow is sort of consolidating too. What I'm saying here is that there's still support in the market, right? That CPI report wasn't treacherous. I'm sorry, it wasn't treacherous. it didn't like, it didn't signal inflation is reaccelerating. When I say reaccelerating, I'm not talking about prices won't go up, because they always do, right? That's how companies increase, margins, or, you know, prices are always going to go up. That's why people invest in real estate and collectibles, whatever it is, right? Food prices slowly go up, depends on the supply chain, but prices do go up. The question is, at what rate of change? Are they going up at 2%, 5%, 6%, 9%? That's where it's bad, when it's going up at 9%. We want inflation for the market's sake, not for the economy, for the market's sake. We want inflation to go up somewhere between 2 and 3%. Okay, as long as the economy stays up. So the market is not reading that as a treacherous report. As a matter of fact, shelter is still falling. Our core is still falling. Core is still coming down, right? Headline is going up only a little bit, right? The trend is not broken. It's just a blip, right? Just like any asset price, you bottom and then you have the trend is still lower. So yeah, maybe there's pause in the market. We consolidate for a couple months, but the trend is still lower, right? Everything is finding support. Equal weight. Look at equal weight here. Equal weight, the equal weight S&P 500, and I'm gonna get you guys' comments, is also consolidating sideways. Dang, where's the tool I'm looking for? There it is. So it also has some support here. So until these really get violated, I'm not really too concerned about the price action, right? And obviously you see, crypto is hanging on there. It's trying to get back above the level. Nothing is falling apart based off the report. Tomorrow we got PPI. Expect that to be a little more positive. Now, part of the reason markets are sluggish is because global liquidity has been decreasing. Global liquidity is pulling back. Okay, global liquidity is pulling back, and we are seeing that. Real quick, let's go through the actual components of the segments of the S&P 500, the sectors. Industrials negative. Somebody might have went positive today. You want to keep this in mind, all right? Industrial is negative. Healthcare negative today. Utilities negative. Discretionary negative. I bet you energy is positive. Staples negative. Communications negative. Banking negative. Oh, that wasn't too bad. They tried to recover there. Materials negative. Real estate negative. And XLE. Where's XLE? Oh, there we go. XLE. Right, I guess XLE has been moving up lately. It did finish the day negative, but XLE is up a little bit. So this is all about energy prices. Energy prices going up a little bit, not necessarily core inflation, but energy prices. Now, if they go up too fast, too much, very bad news. Very bad news. As we've signaled for the past 3 months, that means the dollar is going to go higher, pushed up by yields, and the dollar does look a little bullish. It's still in a downtrend, so let's not give up on the dollar yet. Still in a downtrend. But yields are starting to really wedge here, right? Bond yields are really starting to wedge. And the U.S. Treasury is going to have to do something about this. If they do not start buying back those bonds, or if Japan keeps offloading U.S. Treasuries, then rates go higher, right? Rates go higher, and we might go, maybe 2 or 3 months where growth really starts to fall apart in the economy, and where stocks really start to struggle because because yields are just too high. And that's all driven by the price of oil, right? Other commodities could catch a bid too. So really the key thing here, we're taking a look at oil. Is it going to support the 83.50 level? Are we going to break out next to the next resistance level at 94? That'll push gas prices up. That'll push some services up, transportation prices up. Now that will definitely put the market on hold for a couple months unless something gets fixed there, right? The VIX is not freaking out too much. The VIX isn't really lifting. So I think there's buyers still in the market. They're not buying insurance, like a wild dog. They're just looking for support. And that's what I wanted to mention there. Let me see if I have any. What up, Slime Z? Good afternoon. And again, see, I'm still on vacation, so we don't have the whole setup here. Time's a little off. Or waiting for the baby to come out almost, and then they had to redo it. So I'm over here just on edge, waiting to be an uncle. Anyways, let me get through some of these comments. This is going to be a short stream. I got to get back to what I was doing, and I just wanted to highlight some of that was going on. The Fed is dovish, inflation reaccelerates. So yeah, that's also, if the Fed is more dovish, inflation reaccelerates. Well, I would say the only way inflation reaccelerates is if oil prices keep going higher, because core is falling, and all the components. Watch, where's that component? This is S&P by component. Let's go to that components. I'm gonna show the components part. They're all falling, right? Everything is decelerating. So I hear your concerns, but if we look at these components, you can obviously see energy is negative on a year-over-year basis. All right, energy's been negative, and it just bounced a little bit because oil prices, really, right? Oil prices. Next one is core services X shelter, still falling slightly, but still coming down. In blue, core goods. Core goods are about to go negative. Okay, shelter, the biggest component to inflation. One of these months, shelter is gonna fall. Rents are falling pretty quickly. One of these months, shelter is gonna come down, and maybe we're wrong there. Maybe we are wrong, and maybe shelter stays a little sticky. But when we look at the forward-looking data from Zillow, Redfin, and it does lead by 12 months. So it takes a while for that to get inputted. This is the most lagging indicator of all CPI shelter. So when is it going to come? I don't know. Maybe it takes another month or two. I thought it'd be by the end of summer. So August, which is the next CPI report, right? In September, that CPI report, I believe, will show shelter really start to come down. And we're going to get more progress on headline CPI, and that really depends on oil prices and core coming down. So we might have, if energy stays sticky, right? If oil keeps moving, and listen, if oil moves sideways, inflation still comes down its rate of change. We just don't want oil to move up. If it moves sideways, that's okay. That's fine for the market. It can move sideways, but it cannot go higher. It can't just keep grinding higher. That would be the negative there. And the Fed being dovish, as long as supply is coming into the market, I don't believe it's going to make inflation go up. HD view before earnings. I am not sure. I'm actually not sure. I think they're going to have bad. I would say that Home Depot, I still think they're going to have some pretty bad earnings, right? We're seeing that some stocks are beating on EPS, not on revenues. My guess is consumers are not spending at Home Depot. My guess is consumers are still in the services and they're slowing down a little bit. We're about to go back to school. So I think their spending slows. I think GDP did bottom, but I think it's going to be a little laggy until we get more market liquidity. And we need more market liquidity. But what I do expect is more fiscal policy to come in, because I think things are going to slow. We've had this narrative for a while that spending slows, GDP slows, growth slows, payroll still keeps slowing, right? Manufacturing, it looks like it's starting to recover now because of the fiscal policy. But if we do recover, then we might just see more fiscal, right? Does that reaccelerate inflation? It could. If it does push energy up, yes, right? If the SPR doesn't get or starts to get filled, that could push energy back up. But on the other side, right? We don't know this for sure. On the other side, there's countries that are increasing their supply. They're a million barrels a day on oil. So I think it really all comes down to oil, and that's really the biggest component holding this market back, because earnings are bottoming. We've seen that. It's all about oil, and the next one is the dollar. Where's the dollar headed, right after oil? So the dollar, if oil goes higher, we should see rates go higher. We should see bond yields go up to match that, to front run headline CPI, and then the dollar go higher. That is negative for markets. That is a macro headwind for sure. Okay, so we're gonna stay up to date. Where's oil headed? Where energy prices headed? Everything else is pretty much coming down. So it's just, this is the last shoe to drop for inflation is the oil price. Nothing else is reaccelerating at any significant pace, in my view, right? If I'm wrong, tell me I'm wrong. Show me where I'm wrong. But that's what I see here. So is the Fed going to hike? We still need more data. We don't know yet. We got to see, we need a little more data. We have some more data next week, and we'll go over that. I'll come out with a report this weekend. If you're not subscribed, subscribe to that. But everything is starting to go, negative. Everything's falling apart when it comes to inflation. Goods inflation's pretty much negative. We know energy is negative on a year-over-year basis. Okay, so it comes down to oil. Fed saying no more forecast recession is an open door for more possible rate hikes. Yes, Carbides, 100%. If the Fed, if the economy continues to strengthen to some degree, and you're wishing that the economy doesn't strengthen too fast. You're hoping that the economy flattens out and it strengthens, but it doesn't like reaccelerate extremely fast. You want it to just kind of, some weakness here, some strength there. So the Fed has no reason to hike. Okay. The Fed has no reason to hike. The market right now is not pricing in a hike. So if we get another couple hikes or another hike, then, and I'm watching what the market is. I think it's a 90% chance of a pause in September. That's what the market's pricing in. If that changes, the market could see some more downside. So we're looking at those support levels. Either way, there's a lot of cash on the sidelines still, as always. I think money market funds hit another record high. So there's a lot of cash on the sidelines. And buyers will come in when they see even prices. So what's the biggest risk right now? What is the biggest risk? Still, that's what you got to ask yourself. Are we going to go through some seasonality, some weakness? Yes. August, September is seasonally the weakest month for the stock market. It's September. We're not even there yet. But that also sets up an opportunity for people to buy, right? And so far, market breadth is still here. It's not over yet, right? Market breadth is still here. So this is going to give an opportunity, a healthy pullback for people who just haven't got in, who don't want to chase. This is good for them, but they're going to be cautious. Okay, where's the bottom? So we're always looking for the technical support. Where does the crowd start to come in? What is our signal? We know earnings are bottoming, but the market front run the earnings. Okay, what's going to happen economically? Here's my big thing. China, they're negative PPI. China is negative CPI. What does that tell you? If their CPI is negative, right? If China's CPI is negative, that gives them room to restart their liquidity cycle to continue to print. And if they do that, yes, they devalue the yuan, but global liquidity picks back up. So my guess, I don't know what percentage. I'm going to bet here that when China starts stimulating, and that's why we keep up with the macro reports, we'll see them actually loan growth come up. We'll see their credit impulse increase. We'll see their central bank balance sheet go up. As that happens, global liquidity picks up, and I expect the markets to really maybe show a bottoming pattern, find some support, and then eventually, start to move up if some other things come into line. But we do need bond yields to come back down. We need bond yields to chill out a little bit because they are elevated. Also, you have the U.S. Treasury unloading a bunch of U.S. Treasuries onto the market, pushing rates up. So hopefully a buyer comes in. If they don't, then rates are going to be up a little bit, and it's going to, it's going to suppress prices. But, at some point, they're going to turn around with all the supply that they're selling, and because that's literally, filling their bank account, the U.S. Treasury's bank account. And I expect fiscal policy by the end of this year, right? Biden has a really bad record right now. He has a bad, He has a bad score. What the heck do they call it? He has a bad, very bad. You guys know what I'm talking about. I can't think of it, but he's, I think he's going to keep stimulating, and that'll be another bid. You'll have China pulling up global liquidity, and then you'll get fiscal liquidity coming back in, but there needs time to rest. PPI could surprise bad. Probably the base effects you're saying, PPI could surprise bad. That is a possibility if PPI comes in. I don't think it's still negative, right? So it might have a bounce, but it's still negative. I don't see it coming in bad. I know a lot of people are expecting negative news, but let's not have too much of an anchor bias. Like, we're waiting for that inflation to reemerge, right? We really got to see that happening. And prices right now are dropping, so far for those input prices have been falling. So they're negative, right? If input costs are negative on a year over year basis, the only surprise you get is if they do lead. Yes, Dima Yush, they do lead. They do lead. And those base effects are coming in. So again, like I said, we could bounce for a while and then come back up. But we'll see. We'll see. PPI is tomorrow. This inflation report is not over yet. If PPI does come out much stronger than expected, and it's all about expectations. It is all about expectations. It is definitely not about what the actual level is. It is about expectations. If the market expects PPI to come in at 0 and it comes in at 1%, that's going to be bad for sure. It is leading. Why don't you wear a shirt? Well, I am at the gym. I'm on vacation right now. I'm about to go to the gym. WTI. Yeah. WTI is divergence.eth. Wonder if that's a crypto name. WTI. Again, like, I'm looking at the oil price of oil. Go look at oil futures. Above 83.50 is the breakout. If we break out, support it. Right now it got back below it. If we break out on crude oil, then I'm sure WTI is going forward, going higher. I don't really look at WTI, but if we do break out, we hold the 83.50 level on oil futures, oil is going higher. You could hedge yourself by going long oil for a couple months. but there is some reason to believe that that can't keep up. And I'm actually going to read that off. Let me go, because there's a couple analysts who talked about oil actually getting stuck. Let's see if I can find the I think maybe a couple months possibly. I think this is it right here. Yeah, I'm gonna go through this. Great, have a live watch for a while. Oh, I know it's been a while. Asset Printer, how you guys doing? I'll be back on my regular schedule next week. My brother's wife is having a baby, so we traveled to another state. I'm still here waiting. You know, the baby's gonna come, and all of a sudden they're like, no, we gotta wait because the hospital something. So we're still waiting on it. So I'm a little off my routine. But I think later times when I get back into the routine, we'll do later time streams. It seems like a lot more people are available. And before I get off here, I'm gonna read reasons why oil cannot stick above 83.50. If it does, it does. You're wrong, obviously, right? But I'm gonna give you some reasons why oil may not stick above 83.50. And then I'm gonna get going because I got to meet up with my family that I have not seen for a while. I don't see them all the time. My 401k in cash waiting for the correction. Heck yeah, Dimayush. Hey, look, a lot of people waiting. Cash is paying better than bonds. It's risk-free. Cash is so attractive, and there's so much cash being piled up paying that interest rate. That tells me when these risks do fall apart further, when the Fed does pause, and they might pause, but when the Fed confirms the pause, it's like an avalanche of capital coming out of the money market funds. So in the report, I'll put it in the report. I'm going to show you the money market funds, not the money market funds. I'm going to show you the reverse repo facility. That is the key. The reverse repo facility is the key chart right now. Other than oil, it's oil and reverse repo. Why do I say that? Because reverse repo has $2 trillion of cash parked at the Fed. As it drains out of the Fed, that is the liquidity that lifts the stock market. That is the liquidity that lifts capital markets again, right? As the economy might slow down, that's going to lift capital markets. Number two, oil. If oil stays where it's at, that's going to give investors a little more confidence that, okay, inflation's done, right? Well, are we there yet? Not exactly. We're not there yet, but we are making progress, and that's why we've been in such an uptrend for the past 6 months. I don't think the trend rolls over unless inflation really starts to swing back up, but that hasn't been the case. Interested to see how the loan repayment affects the economy. I think it's a big deal. I disagree, Carbides. I don't really think it matters. I really don't. As long as there's enough jobs, I would say if there's not enough jobs, people are not working, labor participation is low, then it might affect people. Or maybe it's choosy. Maybe some parts of the economy kind of fall apart or weaken back up and others remain where they're at. But again, like I said, I expect more fiscal at some point. Some of those payments for Nvidia and the chips haven't even made it out to the companies yet. So there was an article on that. So once those payments come in, that's also going to be very interesting to see if chips, Nvidia, AMD start to bid back up again. But, things are kind of slow. Likely to fall till around November and reverse in December. Oh, crypto. Yeah. Crypto's all dependent on regulation. We know that. Regulation is king for crypto, right? That's all about regulation, right? I'm looking at the dollar. I thought, hey, if the dollar drops out, crypto goes up. Maybe not. But I think regulation is the catalyst. What's going to happen with regulation is that ETF going to go through. As soon as you get any sense that the ETF comes in, boom, there goes crypto again. It could be November, December. Maybe you're right. But it is all about regulation in the ETF when it comes to crypto. Many people were conditioned to get free money, no financial responsibility with COVID stimulus. Yeah, 100%. They have also been warned for the last 12 months that a recession's coming and all this bad news. So I think people have it in their head. They're not going to be surprised. I think they're already anticipating it. I'm going to have to go in a second. My brother is calling me because I got to get going. But I'm going to read you guys. Congratulations to your brother and his missus. Yeah, 100%. I'll let him know. I appreciate you guys. I'm gonna get off on this first, and I will be back when I can. All right. Appreciate you guys. Talk to you later. Oh, actually, no. I'm not going to do that. Hey, can you call Isaiah? Or Isaiah, can you call Cynthia? Let me go through the oil really quick. I'm going to hit the oil here. All right. And then I'm done. I got to hit the oil really quick. So productions in April, a group of countries. Oh, no, not that. Here's how it goes, right? Oil supply will come in from various sources. So this expert dude, I had a video about him on YouTube. He says that OPEC is going to have to increase supply at some increase production. Okay. The U.S. is already producing record amounts of oil. The U.S. is at record amounts. Hopefully that continues or hits the demand supply. Maybe not, but these are reasons oil will come down. Canada, now also Guyana, I think that's what's called. They're also producing. So we have production because they're trying to take market share. They're trying to take market share as OPEC pulls back their production. Other countries are increasing their production to gain market share. The same way Tesla cuts prices, right, to gain market share in China, for the EV market in China, stuff like that. So that's supposed to be happening. There's also 5 countries: Iran, Iraq, Nigeria, Libya, and Venezuela, which are all showing signs of increase in their output. Okay, that's another one. Maybe this doesn't hit till next month, maybe next week, who knows. Also, consumers are not driving as much. We're also at the end of summer, so demand actually isn't going to be that great. We might not see demand actually come up significantly. This is all supply driven and news politically driven oil prices, not necessarily demand coming back in. This is why I'm like, hey, oil probably won't go back up. Yields will come back down, but in the next 2 months, because we know growth is slowing. Like you said, the biggest risk is really, will growth collapse? Will the Fed step in? Will they cut rates in time? Or will they let things fall apart? That's the other risk, right? So anyways, driving habits also have came down. People have reduced their amount of driving, and electric vehicles are becoming more prominent. So that also is a reason that oil, and these are more secular, some of these. So it's not like it's going to hit next week, but this could be only supply side driven oil prices. And if that's the case, then the demand's not actually there. And hey, we'll see what happens. But until then, I'll catch you guys next time. I appreciate it. I'll try to jump on and give you my output. I think the main story here is shelter still making progress. I mean, core inflation is still making progress. Even though it's little, it's still making progress. And headline all depends on oil. All right. Catch you guys later. I appreciate you. Stay fit. I'm about to go to the gym right now. Stay fit, stay blessed, and I'll catch you in the next episode. All right.